Right, well, good morning, everyone. Welcome to our full-year results presentation. As you can see, I'm joined on stage by Tymon Drakesmith, our CFO, by Peter Cole, our CIO, and Jean-Philippe Mouton, our Executive Director for France. Now, I will shortly introduce our highlights and talk a bit about the market context. Tymon will then talk you through the numbers as usual, and I'll come back and talk in a little bit more detail about our portfolio before opening up the floor for your questions. So, kicking off with the highlights, it's evident that 2014 has been a standout year with increasing momentum across all parts of our business. Top amongst our achievements is the delivery of the highest total portfolio return since the downturn at 13.6%. Operationally, demand continues to grow for our prime retail space, pushing net rental income up over 2%, with an increase of 23% in leasing volumes. On developments, the opening of Terrace du Port in Marseille proved a real game changer for us in the French market. And on investment, we raised over £1 billion of new capital, deploying it intelligently across numerous parts of our business, including into our new Via Outlets partnership launched in 2014. We are confidently achieving our vision to be the best owner, manager and developer of retail property in our core European markets. Our strategy to create a high-quality retail destinations, maximise income generation and enhance our capital strength has continued to drive excellent returns. Net asset value per share has risen to 638 pence, up over 11% in the year. During the 3-year period since we set out our strategy to become a pure retail REIT, we have delivered an impressive dividend per share growth of nearly 25%, with exceptional total shareholder returns of 88%. Our embedded expertise in the retail property sector, combined with positive market tailwinds, should give shareholders confidence that that strong growth will continue. Now, I'm going to give you a flavour of the positive backdrop across our occupier and investor markets. As you can see from the chart on the left, the UK market has seen a clear step up in monthly retail sales growth this year, mostly thanks to positive economic conditions, including an upturn in consumer confidence and spending power. The picture is less clear-cut in France, but as you can see from the chart on the right, the market has moved from a period of decline to a more neutral, if somewhat volatile, pattern. And initiatives such as the proposed new Sunday trading laws in France give us reason to be more optimistic about the outlook than we were a year ago. Now, drilling down into how we're seeing this reflected in tenant sales across our portfolio, the upward curve on the chart on the left shows our UK shopping centre sales growth is now comfortably around 2 to 3% per annum. In France, I'm pleased to report an improving trend in sales at our centres. And following some trading disruption as a result of the first phase of our refurbishment programme, we are now seeing sales growth improve as we take greater market share. Units that we have re-tenanted in France have seen encouraging sales uplifts of 22%, with O'Parinor a top performer following the introduction of Primark. We're now better positioned in France to capitalise when consumer confidence improves. We're also pleased to report further strong momentum in leasing. Demand across all parts of our portfolio has pushed the combined volume of leases up 23% on last year's figures. Furthermore, this figure excludes leases signed for new developments such as Terrace du Port. This rise has been driven by existing retailers continuing to seek bigger and better physical stores and exciting new international brands entering our centres. But perhaps what makes me most delighted, however, is that we have now reached a watershed where we are successfully converting this leasing demand into clear and tangible retail rental growth right across our portfolio. The chart shows UK market ERV turning positive in 2014, but with 2.6% ERV growth across our UK shopping centres, our prime assets are performing some way ahead of the market. As suggested by these forecasts, I believe growth rates are set to increase further in the UK going forwards. Turning now to review the picture for rents across the whole portfolio, as you can see, the pattern has been positive right across the piece. The left-hand column shows our rents secured versus previous passing, which were 9% up in the UK shopping centres and over 5% positive for the group as a whole. Moving across to leasing above ERV, this was also consistently positive, with group leasing 6% ahead of ERV versus 2% reported the previous year. And importantly, as I've said, this is beginning to feed through to ERV growth. As some of our best performing UK centres such as Cabot Circus, Oracle and Victoria Quarter, we saw ERV uplifts of up to 4%. And so finally, before I hand over to Timon for the numbers, let's take a brief look at investment market activity during the period. As you know, 2014 was a year that saw record levels of investment across the UK and France. As a result, we saw yields firming across all subsectors due to the weight of global money. And with the persistence of a low inflation and low interest rate environment in the UK and Europe, appetite for high-quality commercial property investment will continue, potentially driving further yield compression in 2015, albeit perhaps not at the same rate we've seen in 2014. So with that, let me hand over to Timon.
Well, thank you, David, and good morning, everybody. I've got 4 areas to cover today: an analysis of the 2014 financial performance, an update on our cost management activities, detail on valuation trends, including outlets, and a review of our refinancing programme. But before I launch into the numbers, I'd like to announce that our board has decided to discontinue issuing interim management statements. Instead of distributing high-level information in April and November, we will host a more comprehensive capital markets event in the autumn to complement our full year and half-year presentations. So, on to the headline results, and we believe these figures show continuing progress in meeting our growth targets. Net rental income at £305.6 million is up on 2013, driven by a 2.1% like-for-like increase. Adjusted PBT is 5.9% higher than last year, mainly due to uplifts in rental income from Terrace du Port and our premium outlet business of Value Retail and Via Outlets. This translates into an EPS figure of 23.9p, a rise of 3.5% on 2013. Our final dividend at 11.6p per share is up 7.4% year on year. And this growth rate reflects our confidence in future income growth. Turning to the balance sheet, the property portfolio, including outlets, was valued at £7.7 billion at December 2014, showing an underlying growth of 8% on the year. And NAV per share is 638p, up 11.3% on December 13, boosted by that increased portfolio valuation. The loan-to-value fell during 2014 to 34%, partly due to our share issue in September. So next, I'd like to examine the trends in rental income. Here I've summarised the changes in like-for-like net rental income by sector, and the 4 bars show a consistent performance all the way across our portfolio. On the left, you can see UK shopping centres generated an uplift of 2.2%, with significant contributions from centres such as High Cross and Cabot Circus. Gross rents grew by 2.4%. UK retail parks posted a 2.4% improvement in NRI with a positive impact from our parks at Telford, Falkirk and Paisley. This performance represents a recovery compared to 2013, which had been impacted by tenant failures. French retail had a decent year, with Italy D'Or and Place des Halles being the main drivers. And overall, the total of 2.1% increase shown in the right in green is a little ahead of our 2% long-run target. So here I'd like to talk you through the adjusted profit before tax walk, which explains year-on-year changes from last year's number of £168.9 million, shown in blue on the left. And moving across the chart, like-for-like net rental income growth improved profit before tax by £5.4 million. Net disposals reduced profits by £3 million, and those included the disposals of Queensgate and 10 Grosvenor Street. Completed developments such as Terrasse du Port and Monument Mall boosted profit before tax by £10.7 million, and premium outlets provided an uplift of £2.6 million. There was a small underlying increase in administration costs of just short of £1 million. And interest expenses increased mainly as a consequence of lower capitalised interest as Terrasse du Port completed, along with high levels of fixed-rate debt. So the 2014 adjusted PBT figure of £178.9 million is up 5.9% on last year. As you can see on the right, we incurred a one-off charge of £3 million, and this comprised of a £5.5 million expense from restructuring activities, partly offset by a curtailment gain of £2.5 million from closing the defined benefit pension scheme to future accrual. So net of those restructuring costs, profit before tax was up 4.1%. So a year ago, we announced a range of restructuring measures designed to manage our cost base. We're reducing overhead costs at the same time as expanding our development capabilities and digital marketing platform. It's been a busy 12 months, as you can see from the right of the table, and we've progressed occupational moves in London and Reading, as well as rationalising employee costs. Cost management initiatives in France are also on track. So we anticipate holding operating costs at a broadly steady level in the next few years, whilst delivering large developments and innovating our customer experience. With the expected growth in net rental income, the group's cost-income ratio is forecast to fall further, in line with the trend shown in the chart at the bottom of this slide. The old target for 2014 of 24% has been beaten, and we're on track to hit our 21% objective in 2016. Now, turning to the property valuation, we've segmented the portfolio by sector, so you can see the capital value movements over the last 6 to 12 months, shown in the grey box. The largest segment, UK shopping centres, is up 9.6% over the year, of which 2.7% came in the second half. UK retail parks saw a rise in valuation of 9%, 2014, with a noticeable change in the second half, which saw a 4.9% increase, partly reflecting leasing and development gains. In France, our investment portfolio is up 2.4% for the year and driven into positive territory in the second half by Terrasse du Port. Other UK interests, which include our land holdings, increased in value by 3.4%, although, as you can see from the right, this is a modest category. Developments were up 9.1% in the year due to progress at Leeds, Beauvais and the Goods Yard. And finally, I've split out our premium outlet properties, which are valued at more than £1 billion at December 14, reflecting capital growth of nearly 13% over the year. So overall, a portfolio value of £7.7 billion generated a capital return of 8% and a total return of 13.6%. Next, I'm going to review the yield and income drivers of those key valuation movements, and I'd like to focus on the grey box again. The UK shopping centre uplift of 9.6% was caused by a material yield decline, creating 7.4 percentage points of movement, and there was also income growth of 2.3%. UK retail parks saw a rise in valuation, which was predominantly driven by yield compression, in part due to good progress at developments at Thurrock, Rugby and Merthyr Tydfil. In France, our investment portfolio is up 2.4%. Again, there was positive yield shift and income growth, but we were impacted by 2.9 percentage points of other items, which were due to refurbishment costs and higher transfer taxes in many regions across France. The final major segment, premium outlets, generated capital growth of 12.8%, and here driven by 8.2% growth in rental income. So overall, the total portfolio value increased by 5.26% due to yield compression and a further 2.4% from income improvement. So moving on to NAV per share, and in this walk I illustrate the movement from the value of 573p per share at December 13, shown on the left. Valuation increases in our investment and development portfolio increased NAV by 61 pence per share. Our investment in outlets was up an equivalent of 16 pence per share, with positive gains across the board, particularly at Bicester Village, La Roca in Barcelona, and Kildare, west of Dublin. Adjusted profit contributed 24p a share, and dividends paid out reduced NAV by 20p a share. The dilution from the share issue in September impacted NAV by 9p a share, and other items, mainly foreign exchange movements, caused a 7p per share decline, which takes us to an NAV per share of 638p, up 11.3% over last year. So shifting to the analysis of debt, our balance sheet remains very stable. And the 2014 column shows total net debt at £2.27 billion, very slightly up from the end of 2013, primarily due to development capex and acquisitions, which were offset by disposals on our equity issue. Gearing and LTV are lower than 2013 at 46% and 34% respectively. At less than 50%, this is the lowest gearing level for Hammerson for the last 15 years. We had substantial liquidity of £638 million, even after the early redemption of the €480 million bond, which we retired just before Christmas. The bottom half of the table looks at some detailed ratios, and as you know, we've been targeting the weighted average interest rate, which has fallen again to 4.7%. In 2015, we expect it to be lower, as I'll explain in a moment. Interest cover and net debt to EBITDA ratios are similar to 2013, and we anticipate further improvement this year. We continue to closely manage foreign exchange exposure, as shown in the bottom row, and at December 2014, the balance sheet hedge of euro assets stood at 88%. This gives us protection from a weakening euro against sterling, and interest costs generated by our euro liabilities acts as a hedge against the translation of euro-denominated income. And this neatly takes me on to refinancing activities. Over the last 2 years, we've embarked on a major refinancing programme which has been driven by two objectives of reducing the cost of long-term debt and funding our growth ambitions. We executed over £1.1 billion of capital market transactions in the second half of the year. The left-hand side of the table shows the detail of recent financings, including September's share placement, and here the new capital is used to fund acquisitions of High Cross and Via Outlets, as well as supporting our large development pipeline. In July, Hammerson issued a €500 million bond with the lowest ever coupon for a UK REIT at 2%. In the autumn, we triggered the early redemption of the €480 million bond, originally due in 2015, which has been replaced by July's bond issue. This refinancing will save around £8 million of interest costs in 2015, with a resultant boost to earnings per share. We now have a running cost of debt of 4.3%. Earlier in the year, we drew on our debut $443 million US private placement. And I'm pleased to report that this morning Moody's have upgraded Hammerson's credit rating to Baa1, which puts us into an even better position to fund the business in 2015. So that's it from me. I'm now going to hand over to David.
Well, thank you, Timon. Now, before I move on to discuss capital allocation across the portfolio, I want to share details of our 6-point product framework. The framework is now embedded within our business and guides all aspects of our operational activities, from team structures to investment decisions. The reason for employing this framework is to ensure that our best practice initiatives across the likes of retail design, digital solutions and customer engagement are shared right across our entire retail portfolio. We want to deliver a consistent, high-quality offer that is recognised by our retail tenants and their customers. I'm going to focus mainly on the first three of the core principles today. So firstly, best at retail. This is about leveraging our specialist retail knowledge to provide the very best lineup of international brands and innovative stores for our customers. This year, as by way of example, Inditex selected a prominent unit at the Bullring to showcase its first ever UK Zara men's concept store. Victoria's Secret also selected Bullring for its latest flagship store, the third in our portfolio. Retenanting also brought in the likes of Ted Baker, Whistles, River Island, Michael Kors and Smiggle. Entertaining and exciting. Not just how it feels to attend a Hammerson annual results presentation, but takes us beyond retail into the increasingly important area of catering and leisure. Under the guidance of our dedicated specialty leasing team, catering rents have grown by 10% this year, and leisure and catering together now account for more than 13% of our lettable space. We've created catering offerings within our centres which are destinations in their own right, such as at Union Square, Silverburn and Terrace du Port, hence creating strong demand for restaurant units. But most importantly, we're seeing this materially feed through to rents, with catering leases struck at an average of 14% above ERV in 2014, and catering ERVs have grown at 4.5% per annum over the last 3 years. The third box, interactive and engaging, describes our shoppers' digital infrastructure, which includes Wi-Fi, loyalty apps and social media channels. The trials of the Plus app at Les Terraces du Port were very successful, with as much as a 10% redemption rate on offers, and we're rolling out the final version of the Plus app across all of our centres in the UK and France during the first half of this year. So those are just a few of the areas under our product framework, and you'll see more of the other three coming to life in a video at the end of our question session after the presentation. I'm now going to talk through how we are intelligently deploying capital to enhance performance across our portfolio. You can see here 5 areas of focus in 2014. I will start by looking at how we're optimising our returns through acquisitions and disposals. Next, I'll spend some time talking about our retail parks portfolio. France will follow, and then an overview of progress with our much talk about growing exposure to European premium outlets. And I'll conclude by bringing you up to speed on what will be an active year again for us in developments. So looking first at our acquisition and disposals across the year. We continue to evaluate opportunities to recycle our portfolio to deliver higher returns. However, given the quality of our existing retail portfolio, this is a matter of optimising the performance as opposed to a major strategic repositioning. Going forward, we would expect an annual disposals run rate of around £150 to £250 million per annum. Earlier in the year, we announced the sale of Queensgate in Peterborough. The disposal of 10 Grosvenor Street in September marked the final stage of our exit from office assets, and we remain on track to move into our new head office at King's Cross in early June. The proceeds from our disposals and the share placing in September were deployed to acquire stakes in San Sebastian and Nice Étoile, as well as the remaining 40% of High Cross. And since completion on High Cross, we have already secured around £1 million of new rental income from the likes of Urban Outfitters, Bills and Pandora, and our plans to enhance and remodel the centre will commence this year. Bear with me. There we go. Next, I want to spend some time talking about our retail parks portfolio, which, as I said, is sometimes overlooked externally, but which is well placed and generates excellent returns for us. We've been invested in this sector since 2002. Our portfolio of £1.6 billion now accounts for 21% of the whole by gross value. The assets are well let to strong covenants, and occupancy is the highest across our portfolio at 98.5%. Retail parks are beginning to see a clear turning point as the regional housing market recovery gathers pace. In addition, we are seeing more and more fashion retailers and department stores taking space. Furthermore, we've seen a very active in this sector delivering impressive returns. We've realised around a 20% annual return on incremental capital invested over the last 3 years, with the acquisition of the Junction Fund a particular highlight. Now, this slide shows you one of our new retail park developments at Elliott's Field in Rugby. We chose this location for the new scheme because of its attractive position for fashion-led retailers to infill their store footprint to complement store offerings at large shopping centres in the region. Looking at the map, Elliott's Field is enclosed by Birmingham and the Bullring to the west, Leicester with Highcross to the north, and Milton Keynes to the south. But with convenience playing a real part in consumer decision-making, Elliott's Field is ideally positioned for the catchment of close to 500,000 people around Rugby. We've pre-let units to stores including Debenhams, M&S and Next. In line with our 6-product framework, we are transferring across our best practices from our shopping centres to deliver improved unit design and customer services. Elliott's Field is on course to open in Q3 this year and is expected to deliver a profit on cost of just under 40%. With the growing popularity of such fashion parks, we will continue to focus on similar such developments in the future. Abbots Inch in Paisley offers another example of how the capital we're investing is delivering significant returns. We acquired this site in 2012 and immediately opened out planning, completing a £9 million extension and improving the tenant mix by bringing in Sofaworks, Dunelm and Maplin. Demand for space was competitive and we were able to lift rents, with the last available unit going significantly above passing ERV. Within 2 years, we have delivered an underlying returns of 41% and grown rents per square foot by around a quarter. Now turning to France. 2014 was a pivotal year for our French portfolio, with a meaningful upscaling following the opening of Terrace du Port, as well as the acquisition of Saint Sebastian. As a result, we increased our total floor space by over a third. Last year also saw the emergence of positive effects from our refurbishment and tenanting efforts. Footfall was up 1.5% across our portfolio, with improving sales performance. The process of upgrading the portfolio continues, and in 2015 we will complete the development at Beauvais, as well as commence further refurbishment works. We continue to review selective high-quality acquisitions to build on our scale, as well as review appropriate disposals. We're driving the operational improvement of the French portfolio through active re-tenanting. During the year, we rotated 51 units, letting space to the likes of Primark, Lacoste and Kiko. The new tenants we have put in place saw sales uplift on average of 22%. Notable highlights include positive footfall at Italy Deux and Au Parinor, which saw visitors' numbers up by over 20%. And we're currently in discussions with retailers such as Pret-a-Manger, Uniqlo and Nespresso. And by the end of the programme, we expect to have rotated 170 tenants. That's nearly 20% of our French retail offering. But by far, the most notable achievement in France last year was the opening of our award-winning centre in Marseille. It's traded ahead of expectations with over 8 million visitors since opening. Les Terraces du Port is an example of a centre where we have deployed all 6 elements of our product framework to deliver the best customer service, such as the Plus app and digital wall advertising. The uniquely positioned catering offer has been one of the best performing with the highest densities across the whole of our French portfolio. Importantly for shareholders, we have delivered this game-changing project alongside over £100 million of profit and a yield on cost of close to 7%, reinforcing our clear development expertise. This year, we have expanded our investment in premium outlets, and it now totals over £1 billion of gross assets, around 13% of the group portfolio. Our investment is a key differentiator as the only European REIT with strategic exposure to this growth sector. As you will know, we now have exposure to outlets with 2 partnerships, our existing value retail relationship and as a major investor in the new Via Outlets business in 2014. Across both portfolios, brand sales were up 12%. Value Retail's 9 villages continue to benefit from strong demand for luxury goods and a continued expansion of international tourism. Sales across the Value Retail portfolio were up 11%. And as you can see on the right, our stake in the newly launched Via Outlets partnership has now reached £143 million and includes 6 outlet centres. On this slide, you can see the location of these. The Via partnership is targeting the highly fragmented outlet market across Europe, aiming to quickly accumulate up to €1 billion of assets in locations benefiting from large catchments and close to major tourist cities. The partnership will apply its existing knowledge, experience and retail relationships to actively manage the outlet centres and improve operational performance. The latest outlet centre to be added is at Lanquart in Switzerland. This centre has around 90 retail units, including Calvin Klein, Desigual and Hugo Boss, and benefits from being situated in proximity to the wealthy catchment of Zurich, as well as tourists visiting the region for skiing. Across the whole portfolio of Via centres, annual sales were up 13%, with footfall of 12 million. And finally, in this morning's presentation, I want to focus on our sizable development pipeline. We have highlighted our achievements this year with the opening of Terraces du Port, but we are by no means taking our foot off the pedal. We are currently on site with a total of 6 developments. This year, we'll complete our significant retail scheme at Jeu de Paume in Beauvais, bringing around 24,000 square metres of retail and leisure to the region. The scheme is around 2/3 pre-let, to tenants including H&M, Sephora and Calzedonia. On the right is our John Lewis anchored development, Victoria Gate in Leeds. This iconic scheme has attracted strong pre-letting interest from a number of popular premium brands, and we're on track for opening in autumn 2016. These are just 2 of the 6 schemes we're currently on site with, and as you can see clearly from the chart on this page, 2015 sees a step up in activity for developments, including meaningful advances with our major London schemes. Developments are expected to grow to account for around 10% of our portfolio by 2018. And following completion of our current development pipeline, all but 3 of our UK shopping centres will be over 1 million square feet in size. As well as the schemes shown on this chart, we're also evaluating a wider pipeline of incremental projects, and these are set out in the appendix. Clearly, taken together, these developments will provide a significant platform to underpin our earnings growth. Finally, to give you an insight on how we're moving forwards with our major London developments, I'll start with the goods yard. This is our exciting mixed-use joint venture to the east of the city with Ballymore to deliver nearly 19,000 square metres of retail space, 60,000 square metres of offices and 1,400 residential units. We submitted planning this year and received strong endorsement from the GLA and the Mayor of London. We're working on scheme refinements for an amended application later this year with a targeted resolution by year end. At our major extension to Brent Cross, we achieved planning consent in 2014 for 90,000 square metres of additional retail, dining and leisure. We're now in detailed discussions with our existing anchor tenants and continue to work the scheme up and anticipate a total development cost of up to £550 million. Last month, we submitted our infrastructure application and we expect the related CPO process to commence in the spring, with a start on site date targeted for 2017. Now moving on to our transformational Croydon scheme, we've made good progress this year. As we announced in January, the scale of the scheme has been increased with a new enhanced three-storey design incorporating a dedicated catering and leisure level. We're in advanced negotiations with John Lewis to anchor the scheme, along with a redeveloped M&S store, alongside our existing anchors of House of Fraser and Debenhams at Central. The finished scheme will include a core retail offer of over 2 million square feet of shopping, dining and entertainment. The larger scope of the design has increased Hammerson's share of total development cost of up to £750 million. The CPO is underway as we speak, following which we will commence our land assembly process as we begin to commit meaningful development capex. We're on track with our targeted start date of 2016. Brent Cross and Croydon will put us in a great position to win market share of the prosperous outer London retail catchment and are expected to deliver a yield on cost of around 6%. So, to conclude, our business is in a fantastic position with a leading portfolio of high-quality retail assets in strong demand from retailers. Retail rental growth is now kicking in right across our portfolio. In 2014, we delivered an excellent financial result and are confident of delivering further strong and consistent shareholder returns going forwards. With that, I'll now open up the floor to your questions. Right. Alan?
Alan Carter at Oriel. Just trying to get a bit more of a handle on the underlying growth in the UK shopping centre portfolio. At the half-year stage to June 14, you stated that in calendar year 15, you got £12.1 million of shopping centre rent that was subject to lease expiry or break. Whereas in the statement today, that figure's gone up to 21.8 million. I'm just trying to understand what changes there's been within the UK shopping centre portfolio during that period, apart obviously from the sale of Cabot and the acquisition of the balance of High Cross.
Well, remember we didn't sell Cabot, that was Land Securities, so our exposure has increased through the acquisition of High Cross, where we acquired 40%, and the other change, Timon, ERV growth that's come through during the period.
Okay.
Next question.
Good morning, Hemant Kotak from Green Street Advisors. Can you just help us understand what the main drivers are for the increase in costs for your major developments? Obviously, they're big, complex developments and things change, but what's driving that increase, please?
Well, generally, we've increased the size of the schemes. Mentioned at Croydon, we've added a level which is adding more leisure and catering. But Peter, do you want to sort of expand generally what activities undergo?
Yes, a lot of work's been done the last 12 months working up the scheme designs. So these are concepts are broadly similar, but there's a lot more effort's gone into detailed layouts, and that's including more costs. We're also looking forward on our programme as to likely cost inflation in London over the next 5 years. So we're factoring in now increased building costs, we think is appropriate. And we're also targeting high-quality schemes in terms of tenant mix. The overall incentive package, we believe, is appropriate to actually make the schemes happen. So these are more refined costs and actually think better products. As David said, we want to make sure these are leading investments on completion and will show very good growth for the next 5 years. We work very hard to make sure we're creating the top-grade investments.
So improvement in quality. Just to pick up on a point you made, David, when I look back at the 2013 presentation, the area is the same. So has the area increased beyond what's reported in the most recent presentation?
Do you mean for the Croydon project?
For the 3 major projects, yeah.
The area should have increased slightly because we've taken in space. So, for example, at Croydon, we're looking at redeveloping the M&S store. Although the cost is a redevelopment, it's only about a 10,000 square foot increase in the space there. So you see an increase in cost, but not necessarily the area increasing. And then some reallocation of retail into leisure space schemes at Brent Cross and Croydon.
Okay, thank you. And then a question on the goods yard, please. It's obviously a very big mixed-use development. What does your 140 to 160 million cost relate to exactly? Because obviously you've got resi there. Is that not included in the cost of the project, and will you be selling that? And how is that factored into the current valuation, please?
So the cost we've set out is for the first phase, and obviously it's a phase scheme over many years with a number of residential units, 1,400 coming forward over a number of years. Our focus is on achieving planning consent this year. In terms of our forward investment aspirations, we're committed to the scheme, and I wouldn't go any further than that. Peter, do you want to add anything in terms of content?
Yeah, that's the first phase, which is in the middle of the scheme around the station, which is around 4 to 450 units, residential units. So that's really an indication of the sort of quantum investment on each phase. Clearly, residential will be sold, that capital will be recycled, potentially into future phases. So it's saying, from Hammerson's perspective, if we wish to build out, that's the quantum of capital we would expect on a long-term basis.
Just very shortly to finish off, what's the current valuation for the site, please? For the goods yard site?
It's gone up a bit, Hammond, but I don't think it's right for us to talk about it. But it's modest in the context of what it could be worth.
Thank you very much.
Morning, Remco Simon, Kempen. You've talked for a few years now about your ambition to be the best owner-manager of a retail property in Europe. You now diversified a lot more into Europe via outlets, JV. Is it safe to assume that your aspirations in Europe on the continent are going to be solely via that JV now, or do you see yourself going into Europe in other countries and the, say, shopping centre or retail parks business as well?
Well, we have expanded in Europe, you're right, and we put considerable capital into our outlets business, and I think that's been absolutely the right thing to do, with very, very strong returns coming through. And we'll continue to keep investing in that sector, particularly through VIA, our new venture. I wouldn't rule out other territories. Last year we bid on a development scheme in Brussels, for example, and we continue to review the markets for other opportunities. But I would say that our business plan and our core growth is not reliant on that expansion into other territories. With our development pipeline, with the outlet expansion, we have plenty of ways in which we can commit capital, but we would keep other territories under review.
And in terms of expansion, can you maybe talk about how you see opportunities to grow in the current market? The fact that you're only buying 10% of NISA 12 because the overall investment is perhaps not attractive enough. Is that a sign that you see returns on potential acquisitions being too modest, and therefore you're more limited in terms of external growth?
No, I think each opportunity we look at individually. NISA 12, I'll ask Jean-Philippe to comment, was right for us at that level of investment. That doesn't mean that other opportunities wouldn't bring forward a greater investment by Hammerson. Jean-Philippe, you want to comment on NISA 12?
We're just sticking to a strategy. I invest in in product that can yield the expected returns. Nancy, for instance, was earmarked as a potential extension and a lot of reversion. That's why we bought 100% from AXA. Nicetol was a different story. It's a mature asset. So the expected return will be lower than we planned. But getting fees on 90% of the asset brings us to above our hurdle rate, as the revenue yield will be quite comfortable.
Lastly, you set out the growth expectations in terms of ERV growth for the UK business. What is your expectation for France?
Well, I think France, you won't be surprised, is behind the UK, although we saw a modest level of ER growth in France. I think there are some means and reasons to be optimistic. For example, Sunday trading is going to open up. We're hopeful of in France this year. And we're beginning to see an improvement in consumer confidence, but it's only just beginning. So I think I would say that France is probably 1 year, maybe 18 months behind the UK. But going forwards, the prospects, particularly on our assets, having refurbishment that we've done, you've seen the increase in sales that's coming through. I think that prospect is there. It's just we've got to wait for it.
Thanks.
Morning, Jan from JP Morgan. You're guiding for sales, property sales of 150 to 200 million a year. You have the capex also, maybe like to finance or to sort of to reinvest property disposals into capex. You're quite positive on the UK, so there's going to be ERV growth in 15 and 16, and you're outperforming in the UK. I could see sort of a situation arising where capital value growth will continue to be positive, and the LTV will continue to tick down, putting you sort of in a very nice position to be in, when the LTV potentially under 30%. What's your view maybe on returning capital to shareholders when developments motoring through, or sort of the LTV going forward?
Well, we've got plenty of places to invest our money through a very large development pipeline, 1.6 billion. We're on site with 6, so I think that's really our focus. Simon, you want to?
Yeah, I think, as we all know, LTV is a bit of a dangerous metric to focus on, and some of us who've been here before remember that it can rise quite quickly when valuations decline. So we tend to look at other things like interest cover, net debt to EBITDA. And although it's been good at that one level, LTV, to see property values rise during the course of 2014, this is a long-term business. You know, we're managing projects which are multi-year, regenerating cities. So it's wrong to just focus on LTV at a short period of time. And I agree with David, there's a lot of capital for us to deploy wisely and profitably throughout a range of developments as well as acquisitions. So I think we'll always keep a return of capital on the agenda, but I would say it's quite low on the agenda right now.
Good, thank you.
Morning, gentlemen. Mark Muzzy from SocGen. I just have one question regarding the level of EPS growth we should expect over the next 2 years, because if I understand you well, next year is going to be the perfect alignment of the stars, meaning top-line growth, admin cost reduction, and financial cost reduction. Should we expect an EPS above the 7% dividend growth we had this year?
So, as you know, Mark, we don't give a specific guidance because we're a UK company and that's our policy. I think it's appropriate to look backwards over the last 3-year track record, and you've seen growth of 6 to 8%. For modelling purposes, that's a good start, and obviously we'd be delighted to help you with individual assumptions in your model for the future. But I think look at the last 3 years' growth rate, imagine it going forward, and that's a sensible approach.
And just to follow up on Remco's question, do you think size matter in retail? And if yes, what are your ambition to reconcile size, if it does matter, with your European ambition?
I think size is important. It's all relative, though. I think we are a big company. Size is important because we want to enjoy strong relationships with our retailers. We want to attract the best staff. We want to deploy the 6-point product framework we talked about. And we can do that, the size we are. But we continue to grow. We explained that we've increased our French business by 1/3 this year in terms of floor space. And with our very significant pipeline, the company will again be about 50% bigger over the next 5 years through the developments we have. So I'm very comfortable with our rate of growth. And the very positive thing is most of that is within our own control. And we can do that at a price which is very attractive to shareholders.
Thank you.
Morning, Robbie Duncan from Numis. Just looking at slides 53 and 54, which is your rents passing that break or expire, and then your rent review schedule, really to get a material delta, I suppose, in the 2.1% like-for-like NRI, we're going to have to see some fairly material ERV growth. 2.1% like-for-like NRI growth for 3 years, 2.6% ERV growth. It was the first sort of major uplift in your shopping centres. When can we really see that 2.1% like-for-like NRI growth starting to move forward? I mean, it was, if I look over the last 5 years, and you disclosed that, I think, in the statement this morning, it's never been above 3% in that period. How do we get there? Can you help us sort of, on a like-for-like basis, understand that?
Well, I think you have to be a little bit careful on like-for-likes because that is down to, obviously the individual actions in any 1 year. And that can be a sort of bumpy road, if you like. But in terms of the underlying ERV growth, we've delivered in our shopping centres 2.6% this year. And I'm forecasting that will grow above 3% over the next year or two. So I think those rates of growth hitting 3 to 4% is strong. I think that will only come through in the major shopping centres such as we own and our major retail parks. That in itself will give the backdrop to underlying like-for-like NRI growth, but that will depend on rent reviews, leasing, surrenders and all the other things. But over a 5-year period, we will get above that figure.
Okay. And you just commented there on rent reviews, something we're hearing a lot for London offices, but also I think it applies equally across retail. Rent reviews are very difficult relative to new letting. Can you comment on your experiences on how easy it is to do that, to increase rent?
I'll repeat something that I said at the IMS, and I'm repeating it because I got the feeling people didn't necessarily believe me. At Aberdeen, we're achieving a 20% uplift at rent reviews. That is being achieved. At Silverburn, we saw an increase of approaching 15% at rent review. So we are achieving those reviews. I wouldn't say retailers are rolling over and having their tummies tickled, but they never will. But we are achieving rental growth at rent review.
Lovely. And last question. Could you remind me, because I can't remember the answer, what the head lease is on Terrasse de Pau?
Well, it's now, what is it? How many years left on the lease at Terrasse de Pau, Jean-Philippe, now?
64, I think.
It reduces every year, obviously, so we have to keep reminding ourselves. Any more questions? One at the back.
Hi, Sam Warwood from Merrill Lynch. Just wondering on the Nice Étoile acquisition, having 10% and then a sort of financial partner, it seems that with the current environment there's going to be a lot of demand from financial buyers for real estate that may mean it's demand for stuff that you guys wouldn't necessarily want and maybe at prices that are a little higher than you might want, but those guys might not be as good managers of real estate as you are. Is that sort of model where you may be almost more of a fund asset management model, something that could be a source of growth in this environment?
Yeah, I agree with your point. To be clear, though, it's not a core part of our business. I would rather deploy our significant platform and expertise in the business into assets where we have a significant balance sheet ownership. But you're right. At the margin, it definitely can be something that we track through. So it's not something we go out sort of outright to achieve, but for the right opportunity, it can be very attractive. It increases our footprint. Those retailer relationships come into play, and it can be very attractive from an income fee point of view. Any other questions? While you're pausing, are there any questions over those people on dial-in?
To ask a question over phone, please press *1 on your telephone keypad.
I'm getting a no from the team in the back there, so that sounds like no questions. Is that right?
As a reminder, to ask a question, please press *1.
No, we have no other questions. If no other questions in the room, I mentioned earlier our 6-point product framework, and it's always difficult for a chief executive to explain what that really means. So to end, we have a very short video which has a bit more colour in what we mean by the 6-point product framework. So the video, please.